Welcome to the first primer webinar for the Tactical Asset Allocation Strategies. A primer is an introduction that covers how the portfolio works and what investors can expect. Thank you so much for taking this time to join me. I'm Erica Jensen, the president of Respire Wealth Management in Houston, Texas. We have to start, of course, by going through legal disclosures, since this is a financial presentation. All written content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decisions. Opinions expressed herein are solely those of Respire Wealth Management, LLC, and our editorial staff. Material presented is believed to be from reliable sources. However, we make no representations as to its accuracy or completeness. All information and ideas should be discussed in detail with your individual advisor or a qualified professional before making any financial decisions. We are not affiliated with or endorsed by any government agency. Advisory services are offered through Respire Wealth Management, LLC, a registered investment advisor in the state of Texas. In other words, before taking action on any investment that I discuss here, give me a call and I'll be happy to talk you through it and determine if it's right for you. I get a lot of questions, and I'm going to go over the answers to those, to the most common ones. We're going to talk about asset allocation. We're going to talk about what is different between regular asset allocation and tactical asset allocation. The tactical piece may be new to you. However, many clients enjoy that this is built into the investment management at Respire. There are specific rules that we'll use. And then we've got to talk about suitability, which was part of what we covered in those disclosures just a second ago. Asset classes refers to different investment types. Many of you are familiar with these. If you've ever taken an investor risk profile questionnaire to identify whether you were considered a conservative or aggressive or anywhere in between kind of investor, then you're probably invested in an asset allocation strategy or have been at some point in time. There are lots of investment types. Stocks, also known as equities, bonds, which we sometimes call fixed income, real estate, commodities, precious metals, and more. Each individual asset class has its own risk-reward trade-off. By optimizing the mix of asset classes, investment managers seek to achieve the highest possible level of reward while remaining within the constraints of the risk profile of each model. That is, we want the most reward for the acceptable level of risk for the client. These models are stress tested in order to optimize the mixes. You'll notice that on the aggressive end of the spectrum, we've got about 90% stocks and then 7% bonds and 3% cash. And then all the way down the conservative end, there's bonds, 20% stocks, and 10% cash. There is a reason that there's 20% stock allocation there, and it actually makes the portfolio a little bit more efficient, but that stock allocation is only to high quality, large blue chip type stocks within the conservative allocation. You'll notice also, in case that visual representation of the pies is not good for you, that you can see numbers within the table. I'm going to go into the next slide here now, and I don't want anyone to panic because it's going to look like information overload, but just bear with me a moment while I navigate you around the page so you can understand what's going on. Okay, this is the information overload. It looks like a lot. For a moment, try to ignore the boxes, and I'm going to grab the laser pointer and walk you through everything that you are seeing. Okay. So I'm going to focus on 2 years here. I'm going to focus on 2008 and 2009. 2009 was a great year in the market, although at the lowest point in 2009, people had lost over half of everything they had in the middle of 2007. They'd been in constant decline pretty much from one point to another. So 2009 for some people didn't feel like a good year. But it was, if you look at the calendar year returns from January 1st to December 31st. Looking at 2009, we can see that emerging market equity, that stocks from emerging market economies, gained 79%. We can see that developed market 32.5. We can even see that the U.S. markets with small cap and large cap gained 27.2 and 26.5 respectively right here. Those are not returns to be ignored. Those are fantastic returns. We can see here at the bottom the lowest earners or the worst performers of that year were cash and fixed income or bonds. So if you were in those, you were among the worst performers in the year of 2009. If we look at 2008, we flip it on its head, we can see the reverse. So we see emerging market from 2009, we actually see was the worst performer in 2008 with 53.5% down just for that one calendar year. And then we can see large cap was down 37 and small cap down 33.8. And then we can see our best performers were fixed income and cash. The reason I want to show you that is because I want you to recognize that in the worst years, the things that have the lower risk-reward trade-off tend to perform the best, and the things with the higher risk-reward trade-off tend to perform the worst, and vice versa. Now, the other thing I want to show you here is I want to show you this black line that connects the dots across the middle. This represents asset allocations, and specifically what's used for this illustration is a moderate risk tolerance profile. Very similar to the one that I showed you on the previous page, and very similar to the one I'm going to show you again in a moment. So how do you know your risk tolerance profile? There are a lot of different sites that you can visit to determine your risk tolerance, but if you want to visit respirewealth.com, that's respirewealth.com, then at the top of the page, if you click sign up, there's a quick questionnaire that you can access on the page by clicking the sign up button. You can take the test over and over, and you don't have to sign up until you decide you want to. There's the sign up button. The Respire questionnaire is 11 to 12 questions long because some answers to some questions lead to a follow-up question. Some questions look really similar to others but are worded with slight differences. The nuances that I've built into the questionnaire looks at the way that you're answering them and then indicates the ways that you're processing information about returns and risk. Once you've completed the questionnaire, you'll be given a recommended model that suits your risk tolerance and will be invited to either open an account or start the questionnaire over again. We're going to look at this chart of 27 years of the S&P 500. We can see this ramp up that was a bull market in the 1990s, followed by multiple peaks with swift drop-offs that last several years, and then a few years of time to get back up to even. Over these time periods, we have the East Asian financial crisis. We have the dot-com or the tech bubble. We have the global financial crisis. This was the tsunami, Portugal, Italy, Greece, and Spain. This was the tip top right before the U.S. had its first ever credit rating downgrade. And this was the energy industry falling in value when the oil prices were in decline, followed by some deleveraging in China later on that affected large companies in the U.S. In each of these time periods, we don't have to accept the full downside potential that exists in that event. And I'm going to show you why we don't have to accept that. I want to show you this first. This is the global financial crisis. Now notice that there are actually two lines here. There's a red line and a blue line. I have to illustrate a concept for you that can't be measured using the index. So instead, I'm going to use an index fund, a fund that tracks the index. The index is represented by the blue line, and the fund is the red. So if we can agree right now that the performance is almost exact, it's close enough for me to use them to compare apples to apples, then I'm going to use that going forward in order to give you some accurate measurements. Okay, here it is. So this is the fund. Do you see the little bar graph at the bottom? It represents the volume of trades in a given time period. Let me highlight that for you. So you see, regardless of how many shares were traded in a given day or week, the price either went up or down. The price moves whether an investor trades 100 shares or 100,000 shares. If we look at something like a simple moving average, which is a measure that some analysts use, let's say we're going to use the 30-week one. Then every week that's added, every new week that we go through, erases the oldest week in the moving average. The higher the volume of trades and the average price of those trades in a given week, the more likely the moving average is to move in an upward direction. The higher the volume of trades and the lower the average price of those trades, the more likely that the momentum is to go in a downward direction over that period. So greater volume in a downward direction can indicate contagion in the market because it means that enough trades are being placed at lower prices to indicate that big money movers are placing large trades. A greater volume of trades with a lower price. That means they are selling. As an example, when looking at this fund, we can view the moving average to see upward or downward momentum of prices of the S&P 500. By applying a shorter moving average over the top, we can identify some fairly simple rules that will move us in and out of the market. The same thing can be applied to other asset classes. However, depending on the number of holdings, different moving averages have to be applied. For example, a longer moving average is required for a fund with fewer holdings. Other factors such as correlation, market volatility, and the MACD oscillator, which you can see at the very bottom of the screen, come into play to prevent whipsaw, which is rapid movement in and out of the market. And it helps to drive decisions such as early reentry into a holding using dollar cost averaging in some instances. Just applying the rules that I've got here, we can see that there's a clear out signal and a clear buy signal. So imagine for a moment cutting the huge losses out of the middle. The losses on the S&P 500 were about 56% during this period from the top in 2007 to the bottom in 2009. What if you only absorbed a portion of the downside and only missed out on a little bit of the upside? Let's start by using the baseline allocation for the moderate investment model. This one is about 55% stocks, 40% bonds, and 5% cash. In a normal asset allocation model, this allocation would waver very little. You'd have it all the time no matter what the market did. This is considered industry-wide to be an acceptable level of risk and reward for a moderate risk profile. Regardless of asset class behaviors, the allocation would only rebalance. So think of the thermostat in your house. When you set it at 72, the thermostat will actually allow the house to get a little bit warmer. Then the thermostat kicks on, triggering the air conditioner to bring the temperature back down to 72. The difference between the normal asset allocation, which we just illustrated using the thermostat, and the Respire Wealth Management tactical asset allocation model is that tactical asset allocation uses in and out triggers to reduce exposure to significant market downside. If you'll recall from the graph of the fund that tracks the S&P 500, there was the arrow that showed when the rule would activate a move out of the S&P 500. This would move the stock allocation out of the investment model. Once it is removed, the cash is redeployed to asset classes that are still showing a signal to hold, such as fixed income. If the other asset class shows a high level of correlation to stocks, that is, it's also moving downward at the same time, then the model can move into risk-off asset classes, such as precious metals. Risk-off asset classes are the things that investors move to when they perceive risk in the normal market. So after you remove stocks, your model might end up looking like this, with no stocks, more bonds, and an allocation to precious metals, such as gold or silver. To illustrate why it would be beneficial, let's look at how stocks and gold compared during the financial crisis. First, notice the horizontal line that goes straight across the middle. If an investment stayed on that line, it would remain unchanged. 0% loss, 0% return, no up, no down. Anything below the line represents a decline in value from the beginning of the period, and anything above the line represents an increase in value from the beginning of the period. The fund I use to represent the S&P 500 is shown by the red line. A gold fund is represented by the blue line. The two are considered negatively correlated. Remember the correlation discussion. When they're negatively correlated, it means that they usually move in opposite directions because people have a tendency to flee to gold when the stock market plummets. You just have to get there early enough to enjoy the upside as everybody else flocks into it. That is, you have to buy it when it's still low. In order to process this in your head, I want you to think about in 2007. Let me grab my laser pointer. You'll notice here in 2007, in the middle, that gold is actually in negative territory during that time. And stocks are actually in positive territory. And up to this point, stocks had had a really fantastic multi-year rally. Now imagine me calling you up one day and telling you that I just sold the thing that had been doing great and I bought the thing that had been doing really poorly. People worry all the time about past performance. That shouldn't be our concern. We should worry about future performance. Where's the market going tomorrow? So you'll notice that as we move forward in time during these 3 years, gold maintains its position in positive territory, only briefly wavering, but not going below its starting value. This is how tactical asset allocation works. A set of rules are used to move the investor out of the asset class that's unfavorable and into one that is more favorable going forward. And we can apply this to different sectors and different asset classes. The tactical asset allocation strategies have a minimum investment amount of $5,000, but accounts with over $100,000 have an added layer of sector rotation that occurs within the stock portion of the allocation. It works the same way as the asset classes with triggers to move in and out. In order to illustrate the fact that we can apply this to different sectors, here you can see a clear sell signal on the energy sector in 2014. Like with other holdings, you absorb some downside and you miss out on a little bit of upside when you get back in. But in the meantime, you missed the big dip and it freed up cash to deploy to sectors that were doing better. The benefit of using specific rules to run a tactical asset allocation strategy is that you remove emotion, which can drive us to make poor investment decisions. It's not speculative. The tactical strategy is based on quantifiable evidence, hard numbers and data, information that we can see. You probably noticed the word agnostic in the previous slide. I use this word a lot when referring to investment decisions, and honestly, it's industry jargon, but it usually creates a lot of questions from people that don't work in the industry. But it doesn't have anything to do with religion. Whether you're spiritual or not, you may have specific beliefs or ideas about investments based on information that you got from TV, a friend, or the internet. Being agnostic about investment selection means not letting beliefs about a specific stock, sector, or market environment cloud your judgment about those selections. These models are available to all risk tolerances, but besides considering just your risk tolerance, investors should also think about time horizon and liquidity. That is, don't invest if you need the money back in a short period of time, or consider an allocation that's on the conservative end of the spectrum if you do need it back in a short period of time. The strategy doesn't protect against all losses, so if you end up in an aggressive allocation and the market goes down, it could take a while for you to get back up to even, and you don't want to be selling your investments during that time. Depending on how much income you need, it could also affect suitability. Visit www.respirewealth.com to see fee schedules for the models at different asset levels. That's RESPIREWEALTH. Performance is provided quarterly or on demand by using the client portal. In order to ensure that investment model selections are still in line with client goals and needs, I do require my clients to talk to me at least once a year. Some people want to talk more often. Some people want to talk weekly, monthly, quarterly. That's totally okay. But every now and then I run across someone who puts their money in an account, just doesn't care, and doesn't want to talk. In these models, I do ask the clients to commit to talking to me at least one time a year. So thank you. Thank you so much for watching. Please call, email, or visit to discuss whether or not one of the tactical asset allocation strategies could be right for you. Again, this is Erica Jensen with Respire Wealth Management in Houston, Texas.